You receive a job offer for $80,000 per year. It sounds impressive, but when your salary hits your bank account, the number feels much smaller. This confusion happens to almost everyone working in the United States. Today, we will clearly understand the difference between gross pay and net pay and why your salary never looks the way you expect it to. Let's start with gross pay. Gross pay is the total amount of money you earn before any deductions. This is the number written in your offer letter. This is the number recruiters talk about. And this is the number people proudly mention when discussing salary. Gross pay includes your base salary, any overtime you earn, bonuses, and commissions if applicable. If your offer letter says $80,000 per year, that is your gross pay. But gross pay is not what you take home. Now let's talk about net pay. Net pay is the actual money deposited into your bank account. It is also called take-home pay or in-hand salary. This is the money you use for rent, groceries, loans, savings, and investments. Your lifestyle depends on net pay, not gross pay. And this is where most people feel shocked. So why is gross pay not equal to net pay? Because in the United States, salary deductions happen before the money reaches you. These deductions are required by law and regulated by the Internal Revenue Service, commonly known as the IRS. The system is designed so that taxes and protections are collected automatically instead of forcing people to pay a large amount at the end of the year. Here are the most common deductions from a US paycheck: federal income tax, state income tax in most states, Social Security tax, Medicare tax, health insurance premiums, and sometimes retirement contributions like a 401k. Each of these deductions serves a specific purpose. Some fund government programs, some provide healthcare coverage, some protect you during retirement. Let's look at a simple example. Assume your gross monthly salary is $6,667. Before that money reaches your bank account, taxes and deductions are applied. Federal tax may reduce it by several $100s. State tax may reduce it further. Social Security and Medicare take their portion. Health insurance premiums are deducted. And if you are saving for retirement, that amount is deducted too. After all deductions, your net pay might be around $4,400. That means nearly 1/3 of your salary was deducted. This is normal in the United States. Many people misunderstand this. They believe their employer is cutting their salary. They believe something is wrong with payroll. They feel cheated. But the truth is simple. Gross pay is what you earn. Net pay is what you receive after fulfilling legal and financial obligations. Nothing is missing. Nothing is stolen. This is why planning your life based on gross pay is dangerous. Rent decisions should be based on net pay. Loan payments should be based on net pay. Savings goals should be based on net pay. Smart employees always budget using their take-home salary. Here is the key insight. Gross pay looks impressive on paper. Net pay decides how you live. Once you understand this difference, salary stops being confusing, and money starts making sense. Understanding your paycheck is the first step toward financial control. When you know where your money goes, you stop feeling anxious about salary and start making confident decisions. That's the difference between gross pay and net pay. And this single understanding can change the way you see your income forever.